Good morning. Well, so this is all very unprecedented, and this has been the case really since the pandemic first hit all those months ago. But what we're seeing right now is a energy crisis with real wages starting to come under enormous pressure in the UK. At the same time, the labour market is incredibly tight by historic standards. So very high levels of vacancies, very low unemployment, labour market mismatch in many sectors and regions where companies simply can't get labour. And also, since the financial crisis, we've seen sort of growing income disparity in the UK, but also between sectors. So obviously the public sector employees have been held back relative to what we've seen in the private sector. And the wages have started accelerating and now moving over 6% year on year nationally. But again, that disguises big discrepancies by sector. And also regionally. So tight labour market, and then you have the energy crisis hits. And what we're seeing is on the back of that, more workers wishing to see paying conditions in their particular industry and company improve. By historic standards, this is still very low level labour disputes. And we're not seeing anything like we saw at the moment in the late 1970s or early 80s, or indeed going back to the general strike of 26 in the UK. But we should expect to see more of this, and wages will continue picking up as inflation itself continues to rise. But normally when you get labour disputes in the UK, you have higher unemployment, much higher unemployment. This is very, very different. You've got a very tight labour market, which is the contrast with what we've seen before.
So walk me through the economic impact from here. As you've heard, barristers, rail workers, even rubbish collectors walking off the job. I recognise that these aren't critical or highly contributing sectors of the economy, albeit they are important, but as you say, not like the disputes that we have seen in the past. Combined with the energy crisis that the UK is now facing, Goldman Sachs says the economy on the brink of recession. How deep could a potential recession be, and is that your base case right now?
Well, it wouldn't be surprising to see GDP contract slightly, in Q4, as Goldman's suggesting. I mean, what is surprising right now is how well some of the real-time indicators that we follow have held up. But beneath the surface, we have a huge degree of disparity, divergence. Parts of the economy are still doing very well, and other bits obviously are suffering, and that's true by sector, by region, but also, in the labour market. This is also, as I was describing a moment ago, also very obvious. So it may well be a recession. GDP might decline somewhat in 2023. But again, it's very, this is not like, historical patterns. I don't want to suggest that for one moment. But we're also seeing the political situation tilt, and obviously there's much more pressure on the incoming Prime Minister, whoever she or he may be, to actually announce much more in the way of targeted fiscal support. But that may also tilt the Bank of England to raise interest rates even further. So we're in a very, very interesting situation. The Bank of England as well, as you know, is leading the way in some ways in quantitative tightening and actually selling gilts back into the secondary market. So I would expect to see quite a lot of market volatility over the course of the next few weeks and months. That's very, very clear.
David, just expand on your view on how the BOE could potentially respond here to this confluence of economic factors. You say rates could end up over 5%.
Well, that's where they were pre-financial crisis, and I've long felt that's where we could be going. And this is not a sort of target I have for May or May of 2023 or August of 2023. The bank may not be able to move in 50 bip phases. So they raised rates last time by 50 bips. They won't probably go at every single meeting, but the direction of travel to me is clear that on a 2 to 3 year view, bank rate in the UK will probably be back over 5%. But that would be considered quite normal if one goes back to pre-financial crisis. And at the end of the day, we have a situation where wage inflation is running at the moment at over 6%. We've got, core CPI inflation, stripping out things like food and energy, of course, running again over 6%. It's obviously much higher on the headline measure and heading higher. At the end of the day, we've got productivity growth in the UK, or probably trending at the moment, sort of 0.5 a year. We need to get that productivity figure up. Otherwise, we're going to be stuck with unit labour cost growth in the UK, again, around 5% year on year. And that will be pushing the bank, domestically generated inflation, that will be pushing the bank to continue raising rates.